Section 15 is going to be looking at interest rates and monetary policy. So first we start off with interest. And that's just the money that you have to pay in addition to whatever you borrow from someone. So it's the price paid for using money that you borrow. We're going to have two main reasons why we demand money, or why we want and are able to get money. First, we want to make purchases with it, or want to hold it as an asset. So if we want to make purchases with it, that's what we call our transactions demand. So we want to use it as a medium of exchange. The idea that we can use money and then give it to someone else in exchange for a good or service. Now, the level of nominal GDP, or the gross domestic product, is going to be our main determinant in the amount of money demanded for the transactions. And this demand for money, when we're looking at transactions, is going to be directly related to nominal GDP. So if nominal GDP increases, then transactions demand for money will also increase. Next, we have our asset demand. So asset demand is to the extent when people want to hold money. So that's the idea of them just holding it in their hands or holding it in their savings or checking accounts. Now, their other option is to put it into financial assets. So corporate stocks or possibly corporate government or bonds. Now, they incur an opportunity cost when they hold money. And it's the idea that you're foregoing any interest income from loaning it. So if you are not loaning your income, right, then you're just holding it. So that's just your asset demand. And our amount of money demanded as an asset is going to have an inverse relationship with the rate of interest. Because the rate of interest is what you could be getting if you loaned it instead of held it. So when the interest rate rises, being liquid and holding money as an asset becomes more costly. Because remember, there's this inverse relationship between the rate of interest and the amount of money demanded as an asset. So if we take transactions demand for money and the asset demand for money and put them together, that's when we get our total demand for money. So we add up the asset demand and the transactions demand. If we have a change in nominal GDP, then it's going to shift our total money demand curve. So here we have our transactions demand. Notice it's just a straight up and down line. And that's because it's uncorrelated to the rate of interest here. Or it's unrelated, independent. That's because it's mainly based on this nominal GDP level. So if nominal GDP were to increase, we would have a rightward shift of our transactions demand for money. Here, in this part, so here's our transactions demand. On the next one, we have our asset demand for money. Here you can see an inverse relationship between the amount of money demanded and our rate of interest. We add both of these together, and that's how we get our total demand for money. So our total demand is our transaction plus asset, which gives us total. And notice that here we have a straight up and down supply of money, and that's because it's decided by the Fed, or our Federal Reserve. So here, once we have the two, to find the equilibrium, all we do is find where they intersect, come over, and that gives us our equilibrium interest rate. So again, the vertical line is drawn because we have monetary authorities. So that's just our Fed. Right? And then this intersection between the demand and supply gives us the equilibrium price for money, which is just the interest rate. It's important to note that there's an inverse relationship between the interest rate and bond prices, which is another form of a security, which we'll learn more about shortly. All right, so now we're going to start looking into more of the perspective of our Federal Reserve banks. Here, when we start off with the assets, right, our balance sheet, we have assets equal to liabilities, and then plus our retained earnings. So first we start off with our assets. And our two main that we're going to be looking at are securities and then loans that the Federal Reserve can make to commercial banks. When we talk about securities, we're looking at those government securities or those government bonds that are purchased by the Federal Reserve. So the Fed buys those securities. And they're going to be either Treasury bills, notes, or their bonds. Right? Bonds being long-term, notes mid-term, and bills short-term. Now, as Federal Reserve banks can also not only buy them or buy these securities from commercial banks, they can also buy them through the public. And when they do it, it's in open market operations. So just to keep that in mind, we'll be learning about open market operations soon also. So the other thing they can do is loans to commercial banks. And the idea is because it's a claim against the commercial bank. It's a claim against them paying the Fed back. So the next piece in our balance sheet here are going to be liabilities. So we have three main items here on the liability side. We have our reserves, our treasury deposits, and the Federal Reserve notes. Our reserves are the amount that the Fed requires commercial banks to hold. Remember, it's that percentage that they have to hold against their checkable deposits. Treasury deposits are looking at the amount that the Treasury creates and replenishes, and it's whenever they deposit tax receipts or money that they borrow from the public or from commercial banks whenever they sell bonds. So that whenever they sell these Treasury bonds, Treasury notes, Treasury bills. And then they can also have Federal Reserve notes outstanding. Remember, whenever we talk about Federal Reserve notes, those are just dollar bills. So if they're circulating outside of the Federal Reserve Bank, then it's going to be a claim against assets to the Federal Reserve. All right, so our tools of the monetary policy. When we're looking at the Fed and what they can do, we have four main things they can do. First is open market operations, which we'll find is the most efficient and most used. Then we have the reserve ratio, the discount rate, and then term auction facility. So when we first start with our Fed open market operations, we're looking at buying government bonds from or selling government bonds to commercial banks and the general public. So it's dealing with buying or selling government bonds. So remember that it's the most important instrument for monetary policy is this federal open market. So first we start off with buying securities or buying bonds. So remember, they can buy them from either commercial banks or the public. And when this happens, the reserves of commercial banks are going to increase. So when the Federal Reserve banks or the Fed buys bonds or buys securities from commercial banks, the commercial banks are going to give up part of their holdings of securities, those bonds that they then sell to the Fed. And in place, the Fed is going to give them newly created reserves in their accounts from whichever banks bought or sold them the bonds. So the commercial banks' reserves are going to go up by the amount of whichever the Fed purchased. So when the Fed purchased securities from commercial banks, it's going to increase the reserves within the total banking system. So that increases the lending ability of the commercial banks. And you guys should remember from the previous two sections, if we increase the lending capability, thus it increases the money supply. Now, the other thing that the Fed can do is buy these securities from the public. So the public gives up securities to the Fed, and then they get a payment and a check drawn by the Fed. So then the public goes and deposits the check in an account with a bank. Then the bank sends the check against the Fed to a Federal Reserve Bank, thus enjoying an increase in its reserves. So, here the Fed can purchase bonds from commercial banks, thus it increases the actual reserves and thus the excess reserves of commercial banks. And it's important to differentiate between the Fed buying from a commercial bank or buying from the public, because when it buys from a commercial bank, it increases by the entire amount of the bond purchase. Whereas when the Federal Reserve purchases from the public, it only increases actual reserves by a percentage of that deposit. So here, in these two models, will give you a better idea of what we're looking at. All right, here on the left side, we have when the Fed buys from a commercial bank. And over here on the right, we have the public. So, when the Fed buys bonds from the commercial banks, say they buy a $1,000 bond, this will increase the excess reserves of that bank by $1,000. Now, if the multiplier is equal to 5, that will lead us to $5,000 new dollars in the bank system lending. But if the public sells a bond to the Fed, the public then has $1,000 in their hand, and then they go to a bank and they deposit that $1,000 into the bank. Say there's a 20% required reserve rate. Now there's only $800 excess reserves because the bank is required to hold $200. So that means 800 times 5 gives us $4,000 new dollars in bank system lending, and 200 times 5, 1,000 of that is kept as reserves. So it's much more efficient for the Fed to buy bonds directly from commercial banks. Now, the other thing that the Fed can do is sell securities. So the Fed can sell government bonds in which commercial banks buy them, and thus the reserves are reduced. So when the Fed sells government bonds to commercial banks, the Fed gives up securities. Thus, the commercial banks pay for those securities, and they do so by drawing checks against their deposits, which are just their reserves. So the Fed collects it by reducing the commercial bank's reserves. And we all should remember, if reserves decrease, then the money supply will decrease. Now, the Fed can also sell government bonds to the public, and the public just pay with the check. So the Fed will then clear the check against the bank from which that public person drew their check. So then the bank returns the canceled check to the public, reducing the public's checkable deposit. Right? So the idea, if I write a check, me as a person, if I write a check to someone, my checking account will go down. So the person is just writing a check to the Fed. So here, Fed bond sales are going to reduce the system's actual and excess reserves by an equal amount when they're selling bonds to commercial banks. But when the Fed bonds or sell bonds to the public, it's going to reduce it by a lesser amount. So when the Fed sells securities in the open market, the commercial bank's reserves are going to decrease or become reduced. All right, so the next instrument that the Fed has is the reserve ratio. And now we already learned that the reserve ratio tells each bank how much percentage of or how much cents on each dollar they have to keep actually physically in that bank. So if they raise the reserve ratio, that then increases the amount of required reserves for the bank. So they either lose excess reserves, which then diminishes their ability to have lending. Thus, when their lending is depleted, the money supply will also decrease. If they lower the reserve ratio, then it will increase the ability, thus increase new money by lending. Because when you reduce the reserve ratio, banks can now loan more. So it changes the amount of excess reserves, and then it will also change the size of the money multiplier. All right, now it can also do the discount rate. So if a commercial bank really needs to get a loan from someone else and can't get it from another bank, the Federal Reserve Bank can make a short-term loan to the commercial bank. And when it does it, it's charging interest at this discount rate. So it's the interest rate that the Fed will charge on loans that they give to commercial banks. So when they provide the loan, this increases the reserves of the commercial bank. Thus, they become excess reserves. Because all new reserves that they get from the Federal Reserve, they don't need to have a reserve ratio on it. It just becomes excess reserves. But if they increase the discount rate, then it will discourage commercial banks from obtaining reserves through borrowing from the Fed. So if it raises the discount rate, it will restrict the money supply or drop money supply down. Now the last is term auction facility. And it's the idea the Fed holds 2 auctions each month, and the bank will bid for the right to borrow reserves for 28-day periods. So the banks bid against each other for this right. And when they lend through this term auction facility, is going to guarantee that those amount of reserves that the Fed wants to loan is going to be borrowed. It's sort of an idea that the Fed wants to push money into the market, thus increasing money supply. The Fed can do so. So out of all the relative importance out of all of this, buying and selling securities within the open market is the most important. So the discount rate has become more along the passive side and not used as an active tool for the Fed. And that's because the Fed usually just sets it about 1 percentage point above their target rate of interest on overnight loans that it allows commercial banks to make to each other. So this federal funds rate is that interest rate that I just spoke of. So the rate of interest that banks charge one another on overnight loans. So say if I'm a bank and I temporarily have excess reserves, I can earn a little bit of interest on that money, the federal funds rate interest, by lending it to another bank. That's commercial bank. So here in this model, as we decrease the federal funds rate, it's increasing the quantity of reserves. And as you increase the quantity of reserves, you're increasing the capacity or the ability for those banks to lend. If you increase the ability for them to lend, you're increasing the money supply. So when we want to increase the money supply, it's going to be called expansionary monetary policy. So expansionary monetary policy is looking at lowering the interest rate so thus it increases or bolsters borrowing and spending. If you increase borrowing and spending, that increases consumption, which increases aggregate demand. increase aggregate demand, and that will increase real output. So to achieve this lower rate, then the Fed's going to use those open market operations. So if they want to expand this supply of money, then they're going to be looking at buying bonds from banks and the public. Because when they purchase bonds, it increases the reserves of the banking system. And when the banks have greater reserves, the supply of federal funds are going to increase, which lowers that rate. Thus, we saw this increase in the quantity of reserves. And it gives a multiple expansions of the nation's money supply, right? Because we have that multiplier effect. The prime interest rate is a benchmark interest rate that the bank then uses to decide how much interest to change on its loan to businesses and to individuals. So if the federal funds rate increases, expect a higher interest rate on the loan to you as a consumer can get from the bank. See lower federal funds rate and expect lower interest rates that you can get from a bank on a loan. And as we can see here, over time, there's a very high correlation between the two. You see, they both drop together. They stay the same together. Drop again together. Stay the same together. And rise together. So if we want to restrict, or we want restrictive monetary policy, then we just look at doing the opposite. So we increase the interest rate, thus reducing borrowing and spending, which will reduce the monetary supply, and thus curtail any expansion of aggregate demand. And the idea is usually when we do this is to hold down price levels, to keep them from increasing. So the Fed may announce a higher target for their federal funds rate in their open market operations, and thus the Fed will start to sell bonds to banks and the public, and thus absorb reserves within the banking system. And when it does this, the supply of federal funds is going to decrease, and it will have a multiple contraction of the nation's actual money supply because of that multiplier effect. This Taylor rule is going to assume that we have a 2% target rate of inflation. So if real GDP rises by 1% above potential, then the Fed will want to raise the federal funds rate by a half percentage point. So remember, if they raise the federal funds rate, that's looking at reducing GDP, or making real equal to potential. So if inflation rises by 1% above the target of 2%, then the Fed should raise federal funds rate by half a percentage point, again trying to slow down the economy or contract it. When real GDP is equal to potential GDP, so that means inflation is going to be equal to its target rate of 2%, then the federal funds rate should remain at about the same, or about 4%. So there is no change in the federal funds rate. And when we have a federal funds rate of about 4%, it implies a real interest rate of 2%. So our interest rate would equal the inflation rate. Now, this rule came out a long time ago, and still some monetarists want to implement this Taylor rule. But as we've seen, the Fed has a clear willingness to diverge from this actual Taylor rule. So now we're going to be looking at the monetary policy, real GDP, and the price level. So we start off with remembering our total demand is equal to our transactions and asset demands. So now remembering this demand side, we're going to introduce the amount of money that's supplied to get our equilibrium interest rate. So it's this interest rate at which the amount of money demanded and the amount supplied are going to be equal. And it's also important to remember that this interest rate is looking at the real, not the nominal, but the real rate of interest. So down here we have our model. We have our demand for money and then our different supplies of money. So supply 1, supply 2, and supply 3. Our equilibrium occurs in which the supply of money is equal to the demand of money. So we have our first equilibrium. Here we come over, we find that when the real rate of interest is here at 10%, then we are going to demand $125 billion. And we'll also have a supply of $125 billion. And then in our next equilibrium, we have supply of 8%, our real interest rate of 8%, and then we find that our equilibrium quantity of money demanded and supplied is at 150. Notice that as the real rate of interest decreases, our amount demanded and supplied increases. Once again, if we decrease down to 6%, we hit another equilibrium here, come down, and we realize that our amount of money demanded and supplied again increase. Now, this is important because we also have the same relationship between the real interest rate and money demand between the real interest rate and investment demand. So here we see our investment demand curve. Here, at $15 billion of investment, our real interest rate is going to be 10%. If we decrease that real interest rate to 8%, we notice that the amount of investment we have increases. So, when we look at this aggregate demand and aggregate supply model, when investment spending increases, we see an increase in our aggregate demand curve. So here we can see that aggregate demand and aggregate supply are equal here at this equilibrium. And here we're at QF. QF means we have full employment. And here we're at price P2. So this would be our price at full employment. But if aggregate demand were lower than what we wanted, here at this 81, so if aggregate demand was too low, we'd be all the way down here at a GDP of Q1 because our prices are sticky, thus they wouldn't decline down to an equilibrium. We'd be stuck here at P2. So what the monetary policy would want to do is increase or have expansionary monetary policy. And if it's expansionary, our goal is to increase aggregate demand so that we reach this full employment level. Now, if aggregate demand is too high and we have this increase in prices or we have this inflation, then we would want contractionary or restrictive monetary policy. And that would look at decreasing aggregate demand. So if we want expansionary monetary policy, then there's three things that the Fed can do. It can buy government securities from banks and the public or buy bonds, right? And that's doing their Federal Open Market Committee, the FOMC. Or they can lower the legal reserve ratio, right, making more excess reserves for banks so they can lend more, or lower the discount rate, the rate at which banks loan to each other. So this increase in the money supply is going to lower the interest rate, which we just saw. When you lower the real interest rate, you're going to increase investment. When we have an increased investment, that increases aggregate demand, thus increasing equilibrium GDP. Now, if we want a restrictive monetary policy, which I've shown from moving 83 down to 82, right up here, then our Fed is going to want to sell government bonds to the banks and public, or increase the reserve ratio, or increase the discount rate. It's the idea of restricting the money supply, or discouraging investment, because when you discourage investment, it lowers aggregate demand, thus restraining any inflation. Here in this table is a nice cheat sheet of ways to remember what's going on. So here our problem is unemployment or recession, or in our earlier models, too low of aggregate demand. So the Fed is going to want to use expansionary monetary policy. So they buy bonds, lower the reserve ratio, or lower the discount rate. This increases excess reserves. Federal funds rate will fall, thus money supply increases, interest rate falls. Then we have an increase in investment spending, aggregate demand will increase, and real GDP will increase. If we have an aggregate demand curve that's too high, we have inflation. So our problem here is inflation. So we want to use restrictive monetary policy. The Fed sells bonds, increases the reserve ratio, or increases the discount rate. The idea is to decrease these excess reserves, which decreases loaning. You decrease loaning, money supply is going to fall. When the money supply falls, then the interest rate will rise. When our interest rate rises, investment will go down. Thus, aggregate demand goes down and takes away our inflation. So monetary policy has become our big player in stabilizing our U.S. national economy. And there's two reasons why monetary policy is better than fiscal policy. First, because of its speed and flexibility. They are much quicker. They don't have those administrative lags that fiscal policy faces. It also has isolation from political pressure. So it doesn't have to deal with any political parties or any differences or just political playing powers that are in the market. But it does have some problems and complications. So first are the types of lags. So it does have a recognition lag and an operational lag. But like I said earlier, from its isolation from political pressure, it avoids this administrative lag. It still has a recognition lag because the monthly variations in economic activity are not seen until the end of the month or until that data becomes available. Same thing with the changes in the price level. Until we have that data, we don't know that the price level is actually changing. Thus, it's hard for us to recognize if we actually do have inflation. Once the Fed does act, it can take 3 to 6 months or more for the interest rates to actually change. And when they do change, it could take time for them to actually impact investment, thus impact aggregate demand and then real GDP or the price level. So this is our operational lag. We can also have problems where if we have a restrictive monetary policy, then it can reduce the volume of loans within the different banks. Or if the Fed wants to create excess reserves, it can't guarantee that the banks are actually going to increase their loaning. So if they don't make the additional loans, then it won't increase the supply of money. So the Fed can take on an expansive monetary policy, but if the banks don't loan anything, then it's not actually going to complete its full process, and it won't ever get to increasing investment and increasing aggregate demand. So when we look at this, Alan Greenspan was a leader in the Federal Reserve for a long time, and he looked at whether we're using management of our monetary policy tools or if we want to just straightly focus on inflation. And he said to maintain price stability and to smooth out the business cycle, maintain high levels of employment, and promote strong economic growth, it was much more an art than an actual equation, because you had to take all of these into account. Whereas if we were to just focus on inflation targeting, then we would just be focusing on the actual rate of inflation, and just our complete monetary policy would be based on keeping an annual statement of within our target range of that inflation. And this is the end of section 15.